morning, everybody. My name's Louis Memolo. I'm one of the partners at Weiner Benefits Group, and it's my pleasure on behalf of the entire WBG team to welcome you to the first in our monthly market update series of webinars, co-sponsored by some of the top mutual fund investment companies in the industry, bringing us timely and important market and legislative information. Today's webinar will be sponsored by our friends and partners at American Century Investments, and we have Jen Mulrooney, Corey Johnson, and Elaine Bork, who will be our speaker today, and we'll introduce you to them in just a moment. Before we move on there, we want to talk to you a little bit about who we are at Weiner Benefits Group, in case you don't know. We are one of the largest employee benefits and consulting firms in the area, providing a holistic approach to complete financial well-being from hire to retire. You see a picture here of my partners, Deborah Shears and Mike Reckner, and it's our mission to provide you and your employees with a sense of security, peace of mind. We promise you knowledgeable, competent, thorough, forward-thinking, and proactive ideas and solutions to meet all of the needs for you and your employees. Just a little background on some of the other things that how we represent you with our retirement plan services. We provide full service and fiduciary support, fee benchmarking and analysis, investment analysis, target date fund consulting, plan design, and employee engagement. So at this point, I want to turn it over to our host and our account executive, Stephanie Clendenning. You're muted.
Thank you, Louis.
No problem.
And good morning, everyone. Thank you for joining us today. As Louis mentioned, I'm Stephanie Clendenning. I'm the account executive here at Weiner Benefits Group on the retirement plan services. I wanted to quick introduce you to our team. Of course, you know Louis Memolo, the investment advisor representative, myself, Stephanie Clendenning, the account executive, Tom Gillabo, who is also on this call this morning, our associate advisor, and our administrative assistant, Alex Buller. Also wanted to let you know of our future webinars that will be coming. We have BlackRock in August. That's on the 18th at 10 a.m. September will be T. Rowe Price at 10 a.m. And then we have Franklin Templeton October 18th at 10 a.m. And we are working on setting up the rest of the year for November and December. Joining us in November will be Principal Financial, and December will be Vanguard. So we're looking forward to seeing you on those as well. I'm going to turn it over to Elaine Burke. She is going to be presenting to us today. She's Vice President and Senior Client Portfolio Manager for American Century Investments. Elaine holds a bachelor's degree in management and marketing, and she will start the process of our presentation. I am going to be monitoring the Q&A and the chat, which you can find at the bottom of your screen throughout the presentation. If we do need to stop, we will. Otherwise, we will address any questions at the end.
Great, Stephanie. So I'm just going to share my screen here. And just a thumbs up if you can see this for me. Awesome, great. So I really wanted to start with the consumer, because the U.S. consumer is really so key to our economy. 70% of GDP is driven by the U.S. consumer. We really like buying things. That's what we do. GDP stands for gross domestic product, and it measures all of the value of goods and services produced in a country. So it's really an indication of economic activity for the broader economy. And because consumer spending is such an important part of GDP, it can typically provide us with some insights into the health of the economy. And there's typically three factors that influence consumer spending. Those are debt, wages, and confidence. By most accounts, the US consumer actually looks pretty healthy right now. So you can see in the bottom chart, our net worth is near all-time highs. We still have a lot of cash in the bank compared to pre-pandemic averages. Today's consumers have about 2.5 trillion in excess savings. That's based on different data points, and we're continuing to spend that money. For example, travel-related spending has increased sharply this summer. We see airline and hotel bookings up. And at the same time, unemployment is near all-time lows, as you can see in the top chart. So if the consumer is so strong, the question really is, what's the challenge? Well, this data really tells us about what's happened in the past as well as what's going on right now. But it doesn't give us a good indication of what actually could happen in the future. And high wages and excess cash, while they're good for the consumer, they're actually contributors to inflation as well, which is a key concern for the broader economy going forward. So inflation is hands down one of the #1 topics and questions that I get from clients. Unlike other market forces that can feel a little bit foreign to us, inflation, I think, is different, right? We can see it, we can feel it, it touches every part of our daily lives, from putting gas in the car to going grocery shopping. So it's important to really understand what's driving this inflation so we can understand how high it might go and how long it might last. The chart here shows the Consumer Price Index. This is an index that's often used to measure inflation. And you can see that in the US, this index has actually risen over 9.1% versus the same time last year. This is the highest reading that we've seen since November of 1981. And it's really not just a US problem, right? You can see it's happening globally. I think by now most of us understand why inflation is elevated, right? We had this big influx of cash pumped into the economy to offset a potential slowdown from COVID. And then once the economy opened back up, people started spending that cash, and it's driving up prices. We always knew that stimulus would be inflationary. Central bankers around the world, though, felt pretty confident that it would be temporary. In the US, the Federal Reserve, or the Fed, as they're called, they called it transitory, and they use that term over and over to highlight that even though inflation was rising, they expected it to come back down once markets normalized. But inflation has been much stickier than we expected. And I think there's a number of reasons that can account for that. First of all, I think China's zero COVID policies are keeping supply chains backed up much longer than we expected. And then, of course, the war in Ukraine has had a very significant impact on food and energy prices. In fact, I think one of the most significant ways that we're actually seeing inflation kind of filter into the economy is at the pump, right? Gas prices skyrocketed as sanctions on Russia really delivered another shock to global supply chains. Until this year, Russia was actually one of the largest crude oil exporters. It provided 1/3 of all of Europe's energy needs. And you can see these charts are quite telling. As gas prices have gone up, consumer sentiment about the future of the US economy has been going down. Gas prices have, come down a little bit. I think they're hovering around $4.50 a gallon annually, but that's clearly higher than it has been in recent history. So it's no surprise that consumers are feeling anxious about the impact of gas prices, because it means less disposable income to spend on other things. So far, we haven't seen a significant impact on the consumer's willingness to spend, but the longer that gas prices stay elevated, the higher the chance that consumers start cutting back on other items, and that can have a negative impact on the broader economy. It's not just energy prices that are driving inflation, though. We're also looking at other sectors like food and energy that are contributing to this upward pressure on prices. You can see here in this chart, food and shelter have played a significant role in the current inflationary environment, and the three together, energy, food, and shelter, account for over half of all the inflation that we've seen. The rise in home prices really is a function of the pandemic, Americans looking for larger spaces while inventory was really tight. And from a food perspective, the war in Ukraine has had a significant impact. There was a study from the Center for Strategic and International Studies, and they showed that Russia and Ukraine together accounted for more than a quarter of all global wheat exports before the war. So this is a very serious disruption. There is some good news. We're seeing some stabilization in prices. We see, wheat futures and grain have come down a bit as we've had good harvesting season in North America, and the increase in mortgage rates has stemmed some of that demand in housing. We'll take a look at that a little bit more later, but rents definitely remain highly elevated, and this is really key. Even though we're seeing prices come down, they're still much higher than they were before. And it isn't just impacting companies, right? Corporations are clearly feeling this as well. We looked at conference call data. Inflation came up in 84% of conference calls with investment analysts during the first quarter. So clearly this is top of mind for management teams. And this chart actually looks at the percentage of small businesses that say they're going to be raising prices in the next 12 months. While it's come down from a high of around 54%, it's still one of the highest readings that we've seen. So all of this collectively puts a lot of pressure on the Federal Reserve to orchestrate what we're calling a soft landing. So the Fed began raising interest rates in March of 2022. This is the first time they started raising rates since 2018. We've now seen 4 moves year to date. The most recent move was a 75 basis point increase yesterday. That brought the Fed funds rate to a target of around 2.25%, 2.5%. This chart ends June 30th. So that green line actually now has moved even higher. And it appears that, the Fed's target for the end of the year is somewhere in the 3.5% range. So we still expect that there's more rate hikes to come. This tells us that, inflation clearly has reached a point where the Fed feels like they have to act and act very aggressively. And basically, after misreading the inflation backdrop for about a year, it's now got a really challenging task to bring inflation down at the same time that the economy is contracting. And that is clearly not an ideal situation or environment to be raising rates. So it leaves the Fed with a bit of a dilemma, right? If they don't act quickly enough and aggressively enough to tighten money supply, inflation can get worse. But if they raise rates too aggressively, then they risk tipping the whole economy into a recession. And that collectively creates a lot of uncertainty. And the one thing that markets really don't like is uncertainty. So we're seeing a lot of this nervousness being played out in markets. This has been a very volatile period with losses across asset classes across the board. The US stock market actually fell into bear territory in June. So that means there's a decline of greater than 20%. And we had over 22 days where we saw moves of more than 2% in the first half alone. So that level of volatility is significantly above average. Given that markets, really dislike uncertainty, this volatility isn't surprising. And I do expect that it should continue, right? There's just too many unanswered questions about the inflation, the trajectory of inflation, and the Fed's ability to orchestrate a soft landing, as well as when the war in Ukraine is going to end. In the meantime, typically, we tell investors not to let their guard down when it comes to managing risk. That means, staying invested, but being appropriately diversified across equities and bonds. While it's not very common for both bonds and stocks to decline at the same time, like they have recently, there have been periods where this has happened before, and those periods do tend to be short-lived. So diversification still does matter. And we think, in this type of environment, active management probably matters as well. We're starting to see a shift from inflation investing towards recession investing. We're seeing, some indicators of that are, commodity prices coming down. There's rotation between which sectors are outperforming. For example, healthcare, right? That's been a really strong performer in past recessions. That started to show strength. It's true in the bond markets as well. There's there's been some rotation. Active management allows you to kind of adjust to some of these changes in the market and maybe capitalize on some of the shifts that these turning points present. So this kind of a look back. And now I just wanted to take a look at kind of what we're watching going forward. And I want to dig into this concept a little bit of, this pivot from inflationary investing towards more of a recessionary investing mindset. We just got our first look at second quarter GDP this morning. The data did come in weaker than expected. So analysts had expected a slight increase, but instead we actually saw GDP decline almost 1%. Media shorthand typically says 2 quarters of GDP decline is classified as a recession. That's not the technical definition of recession, right? The technical definition comes from the National Bureau of Economic Research, and they say that a recession is a decline in economic activity that's spread across the economy and lasts for more than a few months. So it's much vaguer, and we should also keep in mind that GDP estimates do tend to get revised frequently, so this number is likely to change. But the trend is certainly, moving in the wrong direction. And this is what this chart shows. This is where GDP estimates are currently. The blue bars, this shows GDP across different regions in 2021. And then the green bar is what the expectation currently is for 2022. And you can see that, across the board, 2022 GDP full year estimates are still positive, but they are significantly lower than what we saw a year ago. In the US, we've seen very sharp decline from about 5.7 GDP growth to about 2.5 that's forecasted today. And just like inflation isn't only a US problem, neither is slowing growth, right? We're seeing the same thing happening across regions. We have models that we use that try to gauge the probability of recession. Our proprietary recession indicators, they put the chance of a recession over the next 12 months at around 36% right now. That's up 2% from where it was a month ago, and it's above the levels that we saw late in 2019. Every time that model has moved for a recession probability above 40%, we've always seen a recession. So we are right at the edge of kind of that high recession probability today, and the next few months of data are really going to be very critical. We're really focused on looking at some of these leading economic indicators to get a sense of what if this trend is going to continue. Leading economic indicators, or LEIs, they are typically the first data point in the new phase of a business cycle. So you can see on this chart, they track key indicators that can help us predict the direction of economic movement in the next few months. The June report showed that while LEIs are still at historic highs, they are starting to trend downward. So they're down about 0.5% from where they were 6 months ago. And that suggests that economic activity is likely to slow in the near term. So for example, one input into this index is the number of new orders that are coming from customers. Those dropped to their lowest levels since May of 2020 recently. And shrinking orders, again, are another indication that consumer spending is kind of slowing under the weight of inflation. Some other indicators I think is really important to keep an eye on are housing and manufacturing data. So we've certainly seen weakness in housing statistics. The first chart here shows new home sales. You can see that they have declined sharply as mortgage rates have gone up. And on the manufacturing side, the Purchasing Manufacturers Index, or PMI, it looks at monthly surveys across manufacturing activity from different companies, and this shows that there's trends downwards in both the manufacturing and services sector. Both of the indices still technically have readings above 50, so that's considered expansionary territory, but they're both moving down together. And that suggests that even though, today jobs and consumer data and jobs numbers may seem fine, there could be signs of trouble to come. Our longer view is that we're probably going to be in a risk-off mode for some time until we see some of these key indicators bottom, and that probably doesn't happen until sometime next year. So I think what this means for investors, it's undeniable, I think, at this point that we are likely going to be in for a difficult period in equities, but I would just caution to keep recent events in context. This table I like. It shows average monthly market returns during every recession over the past 50 years. So you can see in the 7 recessions, the market actually produced a positive return in 5 of them. So this tells us that market returns are not necessarily negative during periods of contraction, but we do find that most losses happen very early on in a recessionary period, and it's those asset classes that have the highest valuations that tend to suffer the most. So knowing that, a lot of the losses happen early, we'd caution against making any kind of rash decisions right now, because you could just end up locking in those losses. And as you can see in the chart, the stock market has delivered over the long term, even despite some of these declines that we see in shorter periods. But, obviously, without a doubt, corrections are painful in the short run. For investors that have a bit of a longer term timeline, though, sometimes these sell-offs can create attractive entry points. So, the chart just looks at valuations. Here, the blue bar represents the range of valuations that we have seen in different asset classes over the past 20 years. So the green line is the average valuation the past 20 years, and that yellow dot shows where we are now. We watch valuations because sectors that are trading below their historical averages, could be deemed, attractive from an entry perspective. And if we just look at the yellow dots, there's a number of areas where valuations are starting to get interesting. So you can see, for example, the S&P is trading at around 16.7 times earnings. That's a lot closer to its historical average than it has been over the past, 12 months, I'd say. Growth stocks, on the other hand, they have come down from their highs, but they're still trading slightly above their long-term trend, while a number of sectors like small caps and international stocks are actually trading below their averages. So obviously, just because something is cheap does not mean it's a good value. There's a lot of stocks that are cheap for a reason. But if you have a bit of time to invest in the market, typically as volatility rises, there can be opportunities in these periods, especially if you have more of an active approach, right? You want managers that can do fundamental research, visit companies, figure out how they're planning to adjust their business plans if costs continue to rise. Really looking at companies' risks and their financial positions, because once financing becomes more expensive, those companies with higher debt levels can certainly suffer more. And then, beyond just looking at individual securities, we can also think about ways to really manage our portfolio from an asset allocation perspective. So, tactical asset allocations typically are shorter term tilts within a portfolio towards segments of a market that you'd expect to outperform. Within our portfolios, there's a number of areas where we've made tactical moves recently. For example, we have had a preference for value stocks versus growth stocks for much of this year. That's been a very successful position. Late in the economic cycle, value-oriented sectors tend to hold up better, and we've certainly seen that this time around. We're also looking for opportunities outside of the U.S., right? Economic conditions in the U.S. are tightening faster than in some other areas, and we do think, just looking at that past chart on relative valuations, that there's some interesting opportunities there. as well as, we're looking at things like REITs. REITs we think are going to be kind of challenged going forward. Those are real estate investment trusts. They tend to be very sensitive to rising yields and mortgage rates. So I think that we're kind of cautious on that sector recently. And just a few days ago, we actually implemented an overweight on bonds versus stocks, really due to weakening stock momentum. Indicators like housing and manufacturing indices are all kind of supporting this view that, the outlook for stocks looks a little less promising than bonds at this point, as, data points to a potential slowdown or recession. But of course, these can change as markets evolve. These are just some ideas of ways that your managers may be thinking about positioning portfolios to help you transition through some of these challenging periods. So, couple of thoughts on just kind of guidance on what to do right now. I think if you're kind of accumulating still, you have 10 plus years to retirement, I'd really focus on two things, right? Staying invested. This chart just shows that over the past 20 years, even missing just the 10 best days in a market would have cut your returns in half compared to investors that stayed invested. And it's interesting that half of those best market days actually occurred during bear markets. So don't pull out of the market, just based on some of this very near-term volatility. I always say time in the market has generally rewarded as investors as much as trying to time in and out of the market. So stay invested and make sure you're diversified. I know sometimes, as your investors are accumulating, you think it maybe isn't as important to be diversified, but in reality, diversification benefits everyone and can make sticking to a plan better, especially in these volatile times. If you're nearing retirement right now, again, stick with your long-term plan. I think it's natural to become more concerned about losing value as you get closer to retirement. But if you pull out when the market's down, you are locking in losses. And if you move too much to cash, right, you can miss out on those future gains. This chart actually shows in that lighter green section at the top, you do want some cash, obviously, as you move towards retirement, but there is definitely a risk to having too much cash equivalents, especially because in the long run, cash equivalents are probably one of the worst hedges against inflation that you could have. So, maintaining a diversified portfolio that has stocks and bonds and cash really helps, kind of manage your downside risk, but also keep that money working towards offsetting inflation in the long run. And then finally, for those who are in retirement, the market risk is what we read about all the time. It's what's in the headlines. But the most important risk that we're actually trying to solve for, especially in retirement, is longevity risk, right? The risk that you outlive your money. And to manage that, you have to have the right balance between many of these other risks. So, clearly protecting the value of your investments is important, but you have to weigh that against things like, the fact that life expectancy is longer today than it has been previously. So inflation is a real concern for us, maybe even more than it has been in the past. Inflation is an economic certainty, right? Inflation is going to happen. The only question is it's the annual rate. And stocks have actually proven to be some of the best hedges to offset inflation risk over the long term. So you do need to still have some equities in your portfolio. Just important to find that sweet spot between preserving capital while also making sure that those dollars are working for you to hedge against inflation and longevity risk in particular. So let me pause there. I don't know, Louis or Stephanie, if there have been any questions that have come in during the presentation. I'm happy to address those now.
Thank you, Elaine. Actually, we haven't gotten any questions at this time. But so far, this is great information. Thank you so much. Louis?
Jennifer, did you have anything any comments or anything that you would add?
Thank you so much, Louis and Stephanie, for inviting us to be here today. It's great to partner with your firm. I don't have any comments in addition to what Elaine said. We're happy to stick around for a couple minutes if anybody has questions and answer them, as Elaine noted. But nothing to add in addition to that. I know it's certainly a confusing time for a lot of folks, so I'm very appreciative that you included us in today's presentation. I think it's a great topic that you've brought forward today.
I agree, Jennifer. Elaine, great job. I know we get a lot of questions from our clients right now with the market the way it is. Their first reaction is to pull out and lock in losses. You almost quoted what I say a lot of the time. Just stay as is, and your information about just staying invested, that's part of regular presentations that we do with our clients too. You miss those market returns, often the best days come after the worst days. And
Exactly.
to be out of the market when that happens it can be detrimental. I like your commentary on the shift towards value and some of those value things that are going on right now, and especially in the international emerging market and otherwise, tended to shy away from that area, but now it seems like that's where you should make sure you have some weighting in the international and value. So those of us that are on the call that we work with you on your retirement plans, these are important issues to discuss with participants, and maybe we can address some of these directly with some of your folks. Stephanie, any other questions or anything out there?
No questions coming through.
Tom, did you have anything to add?
No, nothing to add. Thank you, Elaine and team, for your presentation, and thanks for everybody for joining the call.
Thank you so much. Pleasure to be here. Thank you for inviting us, and we'll look forward to returning at some point soon.
Well, thank you everyone for joining the call today. We hope you found this to be informative and timely. We really think it was great to have Elaine and Jennifer and Corey from American Century here today. If you have any additional questions, please reach out to myself, Louis, or Tom. We're always here to help based on the questions we've been getting. We really think it's important to do these webinars and bring you the information very timely. So we look forward to seeing you next month. If you have any questions, give us a call. Thank you, everyone.
Thank you.
Bye.